Hello and welcome to BK Prime. I'm Hiral Dadia. In fact, a great development coming in for the metals industry, especially steel companies. And it's a significant development where the government has rolled back the export duty on steel and iron ore pellets. In May 2022, the government had imposed hefty export duties on steel and its raw materials. And the main reason they had done this was to actually cool down the rising prices and to preserve the domestic supplies. Joining us on the show today to discuss the same and its impact, we have Amit Dixit, analyst at ICICI Securities, joining in. Welcome to the show, Amit. What would your first reaction be? Because this was something that the industry has been asking for quite some time. From August, September onwards is when we've started to hear chatter about the same.
Yeah, thank you for having me on the show. So at the outset, definitely it comes as a great respite for the industry. But I would like to add something that it's like a case of getting an ice cream in the winter. And the point is that currently the steel industry is very, very different from the time when these duties were imposed. So the real impact of these duties, either on domestic steel price or on domestic steel stocks themselves, is expected to be very different from what it was when these duties were imposed. So anybody who is expecting a sharp reversal in either HRC price or these stocks is in for a surprise. That said, there are buckets wherein you can see greater benefit, definitely. But in case of HRC, I really don't see HRC prices going up in a hurry.
Right. So, Amit, my question coming to you is clearly, if you see in terms of the export duties, that led to a sharp fall in steel prices in the domestic markets as well. And if you see in terms of the exports, the steel exports in the first half of FY23 fell by almost 53% on a year-on-year basis. Now, taking the global scenario into consideration, do you think it will be lucrative still for steel companies to still look at exports, or do you think they will prefer the domestic markets?
Yeah, that's a very pertinent point, actually, if you look at beyond the sheen of this announcement. So the thing is that in case of domestic market, the steel prices are already at 11 to 12% premium over landed cost of imports. Now, when you consider exports, you also have to consider the freight component of it. So anybody who is supplying somewhere, he has to supply at $500, let us say, which is the latest HRC export price, minus freight component. So clearly, you are not incurring any margins. The only thing that you may be able to do is probably increase your capacity utilization, which is important for steel companies because they need to produce to the optimal capacity so as to amortize the fixed expenses. However, any incremental exports, in my view, is going to come at a large diminishing margin, essentially. So it's not lucrative to export in terms of margin wise, but if you are intending to increase your capacity utilization, well, the companies might go in for exports.
Right. And when this said and done, when you talk about the export side as well, now global prices in terms of metals is still at the lower end right now. Do you think we have this capacity to still absorb the existing capacity with only domestic, or do you think there will be need of an export market to do that?
See, traditionally, exports have been really for any country, whether it is China or India. If you look at traditionally, we used to export around 5 million tons of steel every year. It all changed in FY22 when we ended up exporting somewhere around 20 million tons. But as you pointed out, this number came sharply down and is coming down with the imposition of export duties. So whenever domestic market doesn't support us, people tend to export because you have to get that steel out somewhere. But in the current scenario where the consumption estimates have been cut sharply down, so if you look at consumption estimate of steel, it is lower than even FY21 for FY23. So FY23 estimates are lower than FY21. And the primary reason why they are less, because China has slowed down considerably. So consumption estimates in China have been sharply trimmed. Now, if you talk about China, it has been an exporter primarily. So now any Indian export, it has to contend with China, it has to contend with Japan, Korea, and Russia. All these countries are traditional exporters, and Russia in particular is a low-cost producer as well. So, uh, you know, first of all, the domestic demand has not picked up as expected after festive season. One of the reasons is that there have been construction curbs in national capital region and everywhere. But otherwise, also demand has remained fairly, I would say, lukewarm for this time of the year. So the first thing is that domestic demand has to pick up for people to get any incremental margins.
Right. So Amit, but if you have to add the China factor, because demand is also something which is weak globally. Once China opens up, that's the only time we will start seeing a pickup in terms of export markets. So taking that scenario into consideration, do you think the prices will still continue to remain under pressure domestically as well as, from an export perspective?
See, domestic market, it's a double whammy of all sorts, because if people increase their prices in HRC, I'm talking only about HRC. The other segments are a different ballgame altogether. Then first thing you have is that you are at 11% premium to landed cost of imports. Immediately there would be booking of imports. So anyways, the headroom to increase prices is not there. Then the second thing is, if prices go up or flare up in domestic market, government can always come back and impose the duties again. So everybody would be very, very cautious in taking a price hike. So that is the scenario as far as flat steel producers are concerned at this point in time.
Right. And additionally, from a steel perspective, specifically HRC, now coking coal import duty has also resumed with a 2.5% kind of a number. Do you think that's something which could impact the EBITDA per ton also negatively of steel producing companies?
Well, that's $7, to be honest. I mean, $7 in the overall scenario is neither here nor there. I won't pay much credence to that. However, if you really look at the steel prices, they have not moved up. HRC steel prices are still at a low level. And coking coal at 300, by the way. Historically, we have never seen these kind of prices. We saw coking coal going up to 300, but it used to retract. But now coking coal has stayed above 300 for quite some time. When I say quite some time, at least 1.5 years, it has stayed above $300 a ton. So cost pressure is definitely there. And with this export duty removal, actually what will happen, something interesting will happen on iron ore side. You will see that since the duty on pellets has been removed, so already people have taken price hike in pellets on Saturday. In fact, Billet index was up 10%. Pellet prices in Odisha went up by another 10 to 12%. There are market chatters of Odisha-based miners taking hike of 10%, around 700 rupees per ton. Now, NMDC can't be far behind. So you will see iron ore prices also start inching up. Now, how much people can pass that through increase in steel prices, that remains to be seen. And that is where margin pressure comes from.
Right. So overall, Amit, from a stock-specific perspective, on the back of the rollback on export duty on hot rolled and cold rolled alloy as well as non-alloy flat steel products, how big a positive will it be for a JSW Steel, Tata Steel, or a JSPL, SAIL, the likes of a Jindal Stainless, Hisar? What would your pick be, and which ones are the companies that would benefit the most on this?
So see, I would again say the benefit would accrue to three groups rather. The first one, Jindal Stainless, because duties on stainless steel have been revoked, and Jindal Stainless has one more positive, that in Europe, particularly due to energy crisis, producers like Outokumpu have actually curtailed their production, so they can export. And the curious thing about Europe is that in Europe, you export high margin product like 300 series. So that would go up, and that would help Jindal Stainless. So Jindal Stainless exports that fell to less than 5% in last quarter can again go up. and they are also able to increase their market share in domestic market. So all in all, a very good sales trajectory for them. Jindal Stainless is the clear beneficiary.
Correct.
Now comes the second bucket, the so-called DRI-IF players for whom pellet prices are relevant. So we have seen across the DRIF value chain, prices have gone up. So a player like Sham Metallics will benefit. A player like Godavari Power and Spark will benefit. Sada, for that matter. So all these players will benefit. Now comes the third bucket, iron ore producers, wherein this Odisha price hike, if it happens, it will definitely help NMDC to raise prices. Not only that, because DRI-IF producers can now ramp up production because export duty on pellets is gone. So that will help NMDC in increasing its volumes also. So clearly for NMDC, I see that both the volumes as well as the prices have bottomed out. So these are the three buckets that are clear winners. I mean, to disappoint you, not biggies like JSPL, JSW, and Tata Steel, they won't be benefited as much compared to these players.
Right. And overall, from a stock perspective, from a valuation perspective, do you think this is something which the markets are already pricing in, taking into consideration the rally that we've seen in the metal counters over the last 2 to 3 weeks?
Well, this was, I believe, the most open secret in the steel industry for a while now. Every fortnight we used to hear that, okay, government is thinking about export duty, and it was also captured in stock prices. If you look at stock prices, despite delivering the lowest possible EBITDA in Q2, the stock prices are above pre-export duty level. So somewhere, market was actually considering that this export duty might not be permanent. It might be temporary. So clearly that is all factored in. But one important thing is that this withdrawal of export duty would be a re-rating trigger in terms of valuations. Not earning a great trigger, but valuation re-rating trigger, because now this overhang at least is gone. People know that there is a relief valve for you. You can export if things become better and you can get better margins. So I think that would play on. So margins, valuation multiples would actually recalibrate back to the pre-export duty levels, which in our view is like almost 10% higher than what they were now.
Right. So do you think this is the time to start owning metal stocks as a part of a portfolio, or do you think it should still be a trading bet? Because there has been a lot of chatter around actually thinking whether this rally is going to be sustainable or not. So what would your view be?
So the only stock that where we have become positive between today and yesterday is NMDC, which we have upgraded to add for the reasons I mentioned. Okay. But on the other steel names, apart from except recalibrating valuation multiples, we don't really see any meaningful upside. So JSPL remains our top pick in the space. We have a target price of 605 rupees on the stock. But that is also because of the long sector is expected to do better. Similarly, SAIL is one of the stock that we have upgraded. But others we believe are, quite fairly valued.
Right. So overall, again, we don't see a major upgrade coming in for the metal sector as a whole. There will be a lot of stock picking that will happen as well. Thank you, Amit, so much for joining us on the show. A pleasure to get your views as well and an understanding of how which companies are going to benefit and how an investor should actually look at them. Thank you so much.
Thank you. Thanks.